California just rewrote the rules of homeownership, and most people have no idea what's coming. These 2026 laws don't seize homes overnight, they squeeze them slowly through insurance, taxes, utilities, zoning, and climate rules working together. Millions of owners could watch equity drain, costs rise, and exit doors quietly close. This isn't about politics or panic, it's about math, policy, and timing. If you own a home, plan to buy, or expect to pass property down, what happens next could reshape your future far more than market cycles ever did. The warning signs are already visible across California neighborhoods today.
Number 1. Mandatory climate risk disclosure at sale. California's 2026 climate disclosure law requires homeowners to reveal detailed wildfire, flood, and extreme heat risk scores before selling a property. These disclosures are pulled from state-backed databases used by insurers and lenders, not optional seller opinions. Buyers now see quantified danger levels alongside price and square footage. According to state housing data, homes flagged as high wildfire risk already stay on the market longer and experience steeper price negotiations. This law formalizes that trend statewide, embedding climate risk directly into every real estate transaction. The financial impact is immediate and measurable. Real estate analytics from 2024 show properties labeled high wildfire risk selling for 10 to 21% less compared to similar homes outside mapped zones. Mortgage lenders increasingly factor these disclosures into loan approvals, sometimes demanding higher down payments or rejecting applications entirely. Insurance complications amplify the damage, since many private insurers refuse coverage once risk scores cross certain thresholds. Without affordable insurance, buyers struggle to close, forcing sellers to cut prices or withdraw listings entirely. For existing homeowners, the risk is long-term equity erosion rather than sudden loss. Owners who plan to sell for retirement, relocation, or medical needs may discover their home value no longer reflects years of investments. Climate disclosure also limits recovery potential, since risks escalate annually as maps update. Even owners who never experienced fires or floods face penalties based purely on projected models, reshaping California's housing market around future risk rather than past reality and stability.
Number 2. Insurance last resort expansion and fair plan dependence. California's expanded insurance last resort law centers on the FAIR Plan, now positioned as the primary option for homeowners dropped by private insurers. Enrollment has surged as wildfire exposure grows, but coverage limits remain narrow and expensive. Policies often exclude key protections like full replacement cost, temporary housing, and water damage. State filings show premiums rising sharply while deductibles increase, shifting more financial risk directly onto homeowners instead of insurers or lenders. The problem intensifies when mortgages are involved. Many banks require comprehensive insurance as a loan condition, yet fair plan policies sometimes fail to meet lender standards. Homebuyers face delayed closings or denied financing, while existing owners risk forced loan defaults if coverage becomes non-compliant. Data from 2025 indicate thousands of households received lender notices demanding policy upgrades that were unavailable at any price. For homeowners, the law transforms insurance from a background expense into a destabilizing force. Annual premiums exceeding $10,000 are no longer rare in fire-prone regions. Combined with rising property taxes and utilities, ownership costs can outpace income growth. This pressure pushes some owners to sell earlier than planned, while others remain trapped, unable to insure, refinance, or move without absorbing heavy financial losses. Over time, reduced buyer demand feeds a downward pricing cycle, weakening neighborhood comparables and local tax bases, which further strains public services and reinforces the insurance retreat across entire communities. This feedback loop accelerates instability and leaves homeowners exposed to systemic risk beyond individual property conditions and regional market pressures.
Number 3. Utility wildfire cost pass-through law.
California's wildfire cost pass-through law allows utility companies to recover infrastructure hardening, vegetation management, and liability expenses directly from ratepayers. These costs are no longer limited to shareholders or emergency funds. Instead, they appear as permanent line items on monthly utility bills. State Utility Commission data shows average residential electric bills in high-risk counties increasing steadily, with projections extending well beyond 2026. Unlike temporary surcharges, these increases compound over time. Homeowners pay regardless of income, insurance status, or whether a wildfire ever threatens their property. In rural and suburban fire corridors, combined electric and gas costs now rival property tax payments. This shift quietly alters the true cost of ownership, particularly for fixed-income households. Mortgage affordability calculations rarely account for long-term utility inflation, creating a growing mismatch between perceived affordability and actual monthly obligations. The broader housing impact emerges during resale and refinancing. Lenders increasingly examine full household expense ratios, including utilities, when assessing borrower stability. Rising energy costs weaken debt-to-income profiles, reducing refinance options during emergencies or market downturns. Prospective buyers compare utility histories across listings, discounting homes with higher baseline expenses. Over time, neighborhoods served by expensive grids become less competitive, dragging down surrounding values. The law effectively transfers wildfire risk into everyday living costs, embedding environmental liability into household budgets. For many owners, the danger is not sudden displacement, but slow financial erosion, where rising bills steadily narrow choices, limit mobility, and undermine long-term housing security across entire regions of California's fire-prone landscape and communities.
Number 4. Zoning Density Override Law. California's Zoning Density Override Law forces cities to approve higher density housing near transit corridors, even in traditionally single-family neighborhoods. Local governments can no longer deny duplex or fourplex projects that meet state criteria. This removes long-standing community control and reshapes land use rules rapidly. Homeowners who bought into low-density areas for stability now face unpredictable development patterns surrounding their properties. The market impact extends beyond construction noise or aesthetics. Appraisers rely on comparable sales, yet forced density introduces mixed housing types that distort valuations. Single-family homes are compared against multi-unit properties, compressing price expectations. Data from recent rezoned areas shows resale prices flattening as buyers hesitate amid uncertainty. Investors gain leverage, while owner-occupants lose negotiating power during sales. For homeowners, the risk lies in long-term equity instability rather than immediate displacement. Neighborhood character shifts can occur within months, while market perception changes even faster. Buyers factor future build-outs into offers, often bidding conservatively. This law also complicates insurance and lending assessments, since denser developments alter risk models and traffic exposure. Over time, zoning overrides weaken the premium once attached to single-family ownership, transforming predictable neighborhoods into speculative environments where homeowners absorb uncertainty without gaining the financial upside developers enjoy. Municipalities gain housing quotas, but residents shoulder value volatility, legal disputes, and resale risk as policy goals override individual property expectations. This imbalance shifts power away from residents and embeds long-term instability into communities once defined by consistency, predictability, and ownership-driven wealth preservation across California's rapidly evolving urban housing landscape statewide.
Number 5. Vacancy and underused property taxes. California's vacancy and underused property tax laws authorize cities to impose annual taxes on homes deemed insufficiently occupied.
These rules target properties left empty for extended periods, including inherited homes, seasonal residences, and houses undergoing long renovations. Local governments define occupancy thresholds, creating uneven enforcement across regions. For homeowners, this converts temporary absence into a recurring financial penalty tied directly to property value. The financial impact scales quickly. Vacancy tax rates commonly range from 1 to 3% of assessed value per year, separate from property taxes. For a median-priced home, that can equal tens of thousands of dollars annually. Retirees, military families, and heirs often face these charges without rental income to offset them. Data from early adopting cities shows vacancy taxes becoming a leading cause of forced sales among non-investor owners. Long-term consequences extend beyond individual households. Buyers factor vacancy rules into purchase decisions, lowering demand for flexible use homes. Estate planning grows more complex as families rush sales rather than absorb ongoing penalties. Neighborhood turnover accelerates, favoring institutional buyers who can maintain continuous occupancy. Over time, vacancy taxation reshapes ownership itself, discouraging long-term holding in personal use in favor of constant utilization. Homes shift from private assets to productivity-enforced properties, where financial survival depends on continuous occupancy or monetization. The law reframes absence as waste, altering how ownership functions in practice. For many Californians, the threat is not abandonment, but coercion, where keeping a home unused, even briefly, becomes financially unsustainable within the state's evolving housing framework.
Number 6. Property Tax Reassessment Expansion. California's property tax reassessment expansion narrows long-standing protections that limited when a home's taxable value could reset. Under updated rules, more property transfers, renovations, and ownership changes now trigger reassessment at current market rates. This shift weakens predictability for long-term owners who relied on stable tax obligations when planning retirement or generational transfers. Reassessment risk has moved from rare exception to common outcome. The financial shock can be severe. Homeowners who remodel for safety, accessibility, or energy efficiency may unintentionally increase assessed value dramatically. State tax data shows reassessed properties often experiencing annual tax increases exceeding 50%. Family transfers, once protected, now face stricter eligibility rules, forcing heirs to choose between selling or absorbing higher tax bills. This disproportionately affects middle-income households holding property in appreciating regions. Over time, reassessment expansion alters homeowner behavior. Necessary upgrades are delayed to avoid tax triggers, increasing safety and maintenance risks. Families accelerate sales after inheritance rather than preserve homes. Buyers discount older properties due to hidden tax exposure. The policy quietly transforms property taxes from a predictable cost into a speculative variable. While marketed as fairness reform, the law shifts fiscal uncertainty onto owners least able to absorb it. The result is gradual displacement through taxation rather than eviction, where ownership becomes conditional on constant financial recalibration. Stability, once central to homeownership, erodes as reassessment risk looms over routine decisions, reshaping how Californians evaluate long-term housing security and wealth retention across generations.
Number 7. Mandatory electrification retrofit rules. California's mandatory electrification retrofit rules require homes to replace gas systems with electric alternatives during major remodels, repairs, or post-disaster rebuilding. Trigger events include kitchen renovations, HVAC replacement, or insurance-funded reconstruction. The policy aligns with emissions targets, but it transfers compliance costs directly to homeowners. Required upgrades often include electric heat pumps, panel expansions, rewiring, and appliance replacements, regardless of a home's prior efficiency or owner preference. Costs escalate quickly once a trigger occurs. Contractor estimates from recent filings show retrofit expenses ranging from $20,000 to $60,000 per property.
Insurance payouts frequently fail to cover the full scope, leaving owners to finance the gap out of pocket. Older homes face higher expenses due to electrical capacity limits. For households already strained by insurance premiums and taxes, electrification becomes a forced capital expense rather than a voluntary improvement. Market consequences emerge quietly. Buyers discount homes with deferred upgrades, anticipating future retrofit triggers. Sellers who complete upgrades rarely recover full costs at resale. Renovation hesitation increases, slowing maintenance and reducing housing quality over time. The rule effectively converts climate policy into a financial gatekeeper, where rebuilding after damage becomes conditional on costly compliance. Homeowners navigating emergencies face compressed timelines and limited contractor availability, amplifying stress and expense. Electrification mandates reshape ownership by tying habitability to capital access, privileging cash-rich owners while pressuring others to sell. The result is uneven adaptation, where compliance determines who can rebuild, remain, or exit California's housing market statewide. Number 8. Short-term rental restriction expansion. California's expanded short-term rental restrictions empower cities to sharply limit or fully ban vacation rentals in residential zones. State backing reduces legal challenges, allowing local ordinances to stand with minimal review. For homeowners, this removes a critical income tool used to offset rising mortgages, insurance premiums, and property taxes. Coastal and tourist-driven regions feel the impact first, where rental revenue once stabilized ownership costs during economic volatility. Small owners relied on flexibility rather than scale to survive in changing markets statewide today. Now, data from housing finance reports shows properties losing rental eligibility experience immediate value adjustments. Buyers no longer factor potential income into offers, shrinking purchasing power. Owners who built budgets around seasonal rentals face cash flow gaps overnight. Long-term leases rarely replace short-term profits due to rent caps and tenant protections, leaving properties less profitable yet more regulated. This mismatch pressures owners to sell sooner than planned, especially in areas dependent on tourism and variable demand cycles, without transition periods or compensation mechanisms from authorities. Over time, restrictions reshape who can afford ownership. Investors with diversified portfolios absorb losses, while individual owners carry concentrated risk. Neighborhoods shift toward corporate landlords or permanent tenants, reducing turnover flexibility. The law reframes housing as static occupancy rather than adaptable use, stripping homeowners of income resilience just as ownership costs escalate across California's regulated housing environment. This accelerates consolidation and narrows pathways for middle-class retention during periods of economic stress and rising household expense pressure, with limited policy relief available for owners statewide.
Number 9. Expanded tenant protection and owner risk shift. California's expanded tenant protection law strengthens rent caps, eviction limits, and relocation requirements, extending rules to many single-family rentals. Owners must demonstrate specific causes for eviction, follow strict notice timelines, and pay mandated relocation fees. These rules apply even when owners need to sell, move in, or address financial hardship. The law shifts housing risk away from tenants and onto property owners, changing the financial equation of small-scale ownership. The market response has been swift. Investor demand for single-family rentals has cooled as regulatory exposure grows. Financing data from recent years shows lenders applying stricter terms to properties with tenant restrictions, increasing interest rates, or denying loans outright. Homeowners lose flexibility during emergencies, unable to reclaim properties or adjust rents to match rising costs, while compliance errors carry heavy legal penalties. These constraints accumulate annually, compounding stress for owners already facing rising fixed costs. Long-term effects accumulate across communities. Small landlords exit first, selling to institutional buyers better equipped to manage regulation. Reduced ownership diversity weakens neighborhood stability and resale competition. Buyers discount rental properties due to embedded tenant risk, lowering comparable values for surrounding homes. The law indirectly pressures owner-occupants as well, since diminished investor demand cools entire markets. Tenant protections reshape housing economics, trading flexibility for security while redistributing risk upward to individual homeowners. This structural shift reduces mobility, delays sales, and concentrates legal exposure, making homeownership less adaptable during economic downturns or personal transitions such as job loss, divorce, or medical crises that demand rapid housing decisions.
Number 10. Climate Managed Retreat Authority. California's Climate Managed Retreat Authority grants local governments power to discourage or block rebuilding in areas labeled high risk for wildfire, flooding, or erosion. Officials may deny permits, delay approvals, or offer buyouts instead of allowing reconstruction. These designations rely on forward-looking climate models rather than past damage history. Homeowners can lose the right to rebuild even when structures were legally constructed and insured under previous rules. Financial consequences emerge once a property is flagged. Buyout offers frequently fall below pre-designation market value and rarely cover relocation costs. Mortgage obligations remain even if rebuilding is denied. Insurance payouts may be restricted when governments refuse permits, leaving owners with unusable land but ongoing debt. Real estate data from pilot retreat zones shows sharp drops in resale demand once restrictions become public. Over time, managed retreat transforms ownership into a conditional privilege. Properties retain tax obligations while losing functional use. Buyers avoid affected zones entirely, freezing liquidity for existing owners. The policy shifts climate adaptation costs from the state to individuals, forcing exit through attrition rather than direct seizure. Homeowners face a narrowing set of choices where maintaining, selling, or rebuilding becomes progressively restricted. The threat is not sudden removal, but gradual erosion of rights, where staying becomes financially irrational long before relocation assistance appears, redefining what ownership means within California's future climate planning framework. Such policies disproportionately impact middle-income families lacking mobility, political leverage, or capital reserves to absorb prolonged uncertainty and delayed government compensation pressures statewide long-term.
What makes these laws dangerous is not any single rule, but how they stack together over time. Insurance limits raise costs, utility surcharges drain cash flow, tax reassessments punish routine decisions, and climate rules reduce long-term certainty. None of this feels catastrophic in isolation. Combined, they quietly reshape what it means to own property in California. Home ownership shifts from a stable asset into a managed obligation, where staying solvent requires constant compliance, upgrades, and financial flexibility. For many households, the real loss is optionality. Selling becomes harder, refinancing becomes riskier, and holding long-term becomes expensive. Equity that once provided security now absorbs policy risk. The people most affected are not speculators, but long-term owners, retirees, inherited property families, and middle-income buyers who planned around predictability. These laws reward scale, liquidity, and adaptability while penalizing stability and personal use. That structural imbalance changes who can realistically remain a homeowner over the next decade. This moment calls for awareness, not panic. Understanding how these policies interact allows owners to plan earlier, budget realistically, and avoid being cornered by slow-moving costs. Staying informed is now part of protecting property value. If this breakdown helped clarify what's happening beneath the headlines, support the channel by liking the video and subscribing for future updates. Share your thoughts or experiences in the comments and explore the related videos on screen to stay ahead of the changes reshaping housing in California. These shifts will define ownership outcomes long before prices, elections, or market optimism signal danger for many.